Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, I want to discuss Hewlett Packard. Is this a dinosaur company? Should we invest our money in it? You're going to want to watch this video. So before we start talking about Hewlett Packard, I recently did a video with Tom Nash, and I just wanted to clarify something regarding growth stocks and value stocks. At heart, the majority of my portfolio and anything I would recommend is always value stocks. That's what should take the majority of your portfolio. And what does that mean? That means a stock that is steady, a stock that has steady growth, has great cash flow, has control over their debt, and it's selling at a good value. They have a good PE ratio. Just overall, anything that you would want to put your money in that's just not a wild growth stock. That's what the majority of my portfolio is. In order to be a profitable trader, that's what you have to do long term. If you want the long term, I look at it kind of like putting your money away in a bank, right? If you put $10,000 in a bank, in 10 years, you're going to have $10,000. Now, the value of that $10,000 obviously won't be the same because of inflation, but it's still going to be there. There's going to be $10,000. So with these value stocks, they're not going to be exciting, sexy, grow 80% in a year, and that's fine. But you should find that you're going to have steady 12%, 13% growth, just a steady revenue of growth. With these value stocks, it's going to be reliable. It's not going to be something that you are going to worry about like you would a growth stock. And that's what I would recommend, number one, and that's what should be the majority of your portfolio. Now, I do have a separate portfolio with high riskier stocks, which I do talk about, and it's just a personal preference. It's what I enjoy. I enjoy trying to find some of these companies like what I spoke about on Tom Nash. Just these companies that aren't the greatest value plays, but they have some potential. And I know how difficult it is to find stocks that are just starting to transition, that are starting to make that move into a bigger play, a longer term hold. But it's something that I enjoy. I know it's high risky. I know it's riskier. So that was just something I wanted to clarify when I did that. And I watched my video, and I know I spoke so much. I was kind of nervous. It was the first time I was on a platform that large, but I just wanted to share that before, we moved on with the HPQ. So HPQ, now this is a company that's extremely interesting to me. Just to be clear, I'm already invested in it, been invested in it for a few months, and I bought it on M1, which there's a link below, and I bought it in the 28s. I took a small position. I just never did a video on it, but I'm doing a video on it today because I still think there's some potential, but I just want to take a quick glance at it. So it has a market cap of 36 billion, short interest of 4%, EPS of 3.73, P ratio of 8.56, which tells me in their sector that it's a great deal. You're getting a good deal compared to its competitors. Let's look at some valuation grades. So again, their PE ratio is at 8.56, and their average sector is 25.3. Just to clarify though, sometimes Seeking Alpha doesn't exactly match up similar companies within their sector. They say sector, but sometimes the companies that they choose don't exactly match. But that is pretty accurate. It's still pretty low compared to its sector. And their EV to EV sales, 0.66, which is good. Another sign that it's undervalued. EV to EBITDA, we did a video on EV to EBITDA, and we talked about how to break it down, how do they come up with the formulas, how it's a useful metric when you kind of putting everything together as a whole to see if this company is undervalued. And it is 6.31 in its sector. It is undervalued, and it does have a dividend yield of 2.53, and their cash flow allows them to cover that dividend yield. We talk about cash flow several times, and we want to invest in companies that have good positive cash flow. Because they use it on their own company. They use it to pay this dividend yield. This company buys back its own shares. And actually the CEO, which is Toni, and he's been a part of HPE, the Hewlett Packard enterprise, for over 20 something plus years, over 25 years. And I think he's great. I think it's a great sign that you have the same CEO for so long. He came out on Jim Cramer and he talked about buying back so many of their shares, and he defended it because he said that they feel that they're undervalued and that they feel they have a lot of potential and a lot of upside still. And I agree with him. I think I think even though they're an old company, they're not exciting. Everybody wants the new and exciting. I think they're trying to get in the 3D space of printing. He talked about that. And that's going to be another potential stream of revenue, along with the steady revenue that they are already having. I mean, a dying company does not have steady revenue like this company does. So let's look at their financials. If we take a look at their revenue, we'll notice that from 11 to 13, they almost cut their revenue in half. In 2014, they took a big dive. But since that, they've recovered. They've steadily made over 50 billion pretty much every year, steady, just kind of growing 50, which is what you want to see. You want to see a steady increasing revenue growth. It doesn't have to be anything spectacular going from 50 billion to 100 billion, but 56 billion, 52 billion, 58 billion, 58 billion, 56, 62 billion. I mean, it's steady and increasing, which is what you want to see. Then along with that, their gross profit is also been increasing. So their cost to make their revenue is under control. It's reasonable. And their operating income. So we made a video on income statement, and we broke down that the top part, the revenue, is their direct cost of earning this profit. So they make this revenue, and their direct cost, to make that revenue, like the parts to the printer and all that, that's what after they pay that, this is what's left over, the bottom down here, 10 million, 11 million. Then their indirect cost, like their R&D expenses, selling, general and admin, you still have 3 billion, 4 billion, 4 billion. And then after they pay their taxes, then you're left with a net income of 2 billion, 3 billion. So a profitable company that's going to have free cash flow. Now, one of my favorite things about this company, or two of my favorite things, is that they pay dividend. So you have the opportunity to invest in a company that is profitable and paying dividend, and they're using their money to also buy back some of their own shares, which they defended because, like I said, they feel like they're profitable, that they're undervalued, and I agree with them. And it's a great sign. So if we look at their shares here, they had 2 billion in 11. Come to today, 2020, they're down to 1.4 billion. Pretty much every year, their shares have been going down. So they don't have to dilute their shares to raise money. They're able to invest in themselves. They're able to pay dividends. They're able to take care of everything just based off of their own sales, off their own work, which is a great sign. I love to see that. Not flashy, not exciting, but this is, honestly, this is 90 something % of your portfolio should be these kinds of stocks, like these value plays. And then all the other garbage, exciting, fun stuff that it's I guess, kind of like your if it's investing, this is your cigarettes. Like, it's just your bad habits. I recognize that it's so difficult to pick a growth stock early and hope that it's going to be one of these big stocks. But I do have some cash set aside for that, which I'm not married to, that I'm fine. I know it's riskier, but this is like 20 years, 30 years. This is kind of like what you invest for your kids. So if we look at their cash flow, steady every year. 2016, close to 3 billion. 2017, 3 billion, 3.9 billion, 3.9 billion, 3.7 billion, 4.9 billion. And they've made quite a few acquisitions. Their chart here, I was looking at this chart for a while. I got in around 28. And you see here, they've kind of hit resistance, support, resistance, support, resistance. They just broke out of that. If you're a technical analysis trader, this would have been a great opportunity, especially when they formed the bull flag here. They kind of pulled back, and the high, the break of a new candle here. So like this candle here, this candle broke this candle, followed by a bullish signal candle. This would have been a good entry here. So you would have entered here, the break of this candle here, which is 30. And your exit strategy, if you're a technical analysis player, would be the bottom, the low here, 29.70. And that's a bull flag. So the bull flag gives you your entry here, and your exit would be here if it dropped. And you see here, you would start taking profit at the highs of this bull flag here. So 30.93. So that would have been a, $30 to about 31, about 1 point possibility technical analysis play. If you're a swing trader, that would have been the strategy. But we're looking here, financial, more fundamental. Do we want to hold this in our portfolio for the next 10 years? That's kind of what we're trying to understand right now. So just kind of like brief overview scan. I mean, everything looks good so far fundamentally. And just reading through their last quarterly, their 10Q, they're definitely profitable. They're definitely doing good things with their free cash flow. They're investing in themselves, and they have plans to continue to grow and stay competitive. And they're trying to get into the 3D printing market. Now let's look at some DCFs that I did. I actually did 3 DCFs for this company. Okay, so their first DCF is just solely based on their cash flow, right? So we take their cash flow from 16, bring it to 220, and then we anticipate how much cash flow they're going to have each year. So we have here a 7% growth. I just kind of like predicted that they're going to stay in that 3.9, 3.8, 3.9, kind of what they have been doing for the last 5-6 years, which is staying in that range of the 3.8, 3.9 range. And if I just base it off of that, I take all that, bring it to the terminal value of it, subtract financial liabilities, add cash, have the equity value. Once I have the equity value, I have the shares outstanding. Here's the equation for the terminal value. Once we have all that, it gives us our fair value per share. And this is, of course, this is a hypothesis. This is a thesis. This is what I anticipate based off their free cash flow. This is what I think they should be worth, $35.28. And their current price is $31.95. That right there, that is good. There's upside, but I definitely want to have something that has more than 12% upside if I'm going to invest in it right now. This is my first DCF, and it's a maybe just based off of this DCF. Once that DCF was positive, I did a second DCF here where I take pretty much everything that they've done the last 5 years, their revenue, their cost of revenue, their income. This is basically their income statement. And then this is their quarter endings, and it includes their cash and short-term investments, their total current liability, working capital. Then we take here their revenue growth and what we anticipate the percentage of revenue, the EBITDA percentage of revenue is going to be for the next few years. And I've just kept it status quo, what the average is, what they've been doing. We take into account their depreciation and amortization, EBIT, their capital expenditures. Then we have their terminal value, their shares outstanding, and it gives us a fair value of $39.14. So what I do now with that is I take that fair value of $39.14, their free cash flow DCF that we just previously did, which was $35.28, and I try to get an average of the two, which is $37.21. So based off of those numbers, there's a potential 16% upside, which is a little better. I like for the free cash flow and this model here to both have at least 13 to 15% upside. So I'm like right on the fence. I think if you were going to take a position in this, sell some puts around here, $29. If you can get back in here, because I think when it pulls back, what a good sign would be, this was previously resistance, support, resistance, support. So you see it was going in this channel. This was resistance, support, resistance, support, resistance, support. And then it broke resistance. A good trend, a good gauge is that when it comes back and tests this area, if this becomes support when it was previously resistance, then hopefully this is going to be the new ceiling, and this will now become support every time, and it'll establish a new resistance. I am bullish on this. I do think it deserves a little bit more due diligence. You may want to go through their annual reports, kind of see what their future plans are. You can listen to some of their quarterly reports, but just understand that it's a show, it's a spectacle. They're selling their company. They have to increase their share prices. So you may want to just kind of see the sector that they're trying to get into. They're trying to, right now, based off their printers that they're selling, they've been steady having their annual revenue, and that's pretty much been steady. So you just want to see if they're getting into a new field, how competitive it is, what's the market cap, what's the market share potential, and do they have anything that's going to make them stand out and allow them to be profitable in the new sector of 3D printing that they're trying to enter. I do think this is a good company. I do think it's good to have in your portfolio. I wouldn't blame you if you got it now, but I do think that there is going to be a pullback. I don't like buying stocks right before earnings. Sell some puts in the 30s, 29s. Try to get into a position there and hold on for the long term. I think that it's going to pay dividend. I think that this company is going to be around for the next 5-10 years. This is a hold for me. I'm not adding to any position right now. And that was my video. Thank you for watching. Please subscribe, comment, and like, and see you on the next video.